On April 8, 2026, the United States and Iran agreed to a 2-week ceasefire mediated by Pakistan in a war that had already killed thousands of people, closed the Strait of Hormuz, sent oil prices from $70 to $120 per barrel, pushed American gasoline above $4 a gallon, triggered the largest monthly inflation spike since May 2022, and sent consumer sentiment to the lowest level ever recorded in the history of the University of Michigan survey, lower than during any war, any recession, any financial crisis, any pandemic, going all the way back to the 1950s. The ceasefire was announced just hours before a deadline that the president had set for what he described as wiping out the entire Iranian civilization. Markets rallied. Oil dropped 13%. The headlines said the crisis was over. The anchors said peace was at hand, and the American public, exhausted by 6 weeks of escalation, breathed out. That exhale was premature. By April 9th, there was no sign that the agreement to lift the Iranian blockade of the Strait of Hormuz was being implemented. Ships were once again being prevented from passing through the strait. Abu Dhabi National Oil Company CEO Sultan Al-Jaber said the strait was still not open because Iran is restricting and conditioning traffic. 230 loaded oil tankers were sitting inside the Gulf with nowhere to go. By April 12th, Vice President Vance announced that the talks between the U.S. and Iran in Islamabad had failed. By April 13th, Trump declared a U.S. naval blockade of the Strait of Hormuz and announced that the Navy would clear it of mines. Iran's IRGC Navy said any military vessel approaching the strait would be considered a ceasefire violation and would meet a severe response. Israel launched the strongest wave of attacks on Lebanon since the start of the war, and Iran paused Hormuz traffic in retaliation. The ceasefire was not a ceasefire. It was a press conference, and the price of everything you buy in America is going to reflect that reality for the next 12 to 24 months, whether the fighting stops tomorrow or continues for a year. Because the damage to global energy markets, to shipping infrastructure, to refinery output, to supply chain confidence, and to the inflationary trajectory of the American economy has already been done. The lie America believed was that the ceasefire meant the crisis was over. The crisis is not over. The crisis has barely begun to show up in the prices you pay. The International Energy Agency called this the greatest energy security challenge in history, and they meant it. The head of the International Energy Agency used words that have never been used before by any IEA director about any energy event in the 52-year history of the organization. He described the situation caused by the war as the greatest global energy security challenge in history. Not the greatest since the 1970s oil embargo. Not the greatest since the Iraq War. The greatest in history. That assessment was based on a specific set of facts that most Americans have never heard explained in plain language. The Strait of Hormuz is a narrow waterway between Iran and Oman, through which approximately 20% of the world's oil and a significant portion of global liquefied natural gas transits every day. Before the war, approximately 21 million barrels of oil per day passed through the strait. When Iran closed it on February 28 in retaliation for U.S.-Israeli airstrikes that killed the supreme leader and destroyed a large number of military and government targets, the restriction of shipments exceeded 90%. That is approximately 10 million barrels per day of oil production trapped inside the Gulf with no route to market. Saudi Arabia and the UAE have limited alternative pipeline capacity that can bypass the strait, but those alternatives carry only a fraction of the volume. More than 80 energy facilities across the Gulf were damaged during the fighting, including refineries, terminals, upstream production sites, and pipelines. The IEA reported that more than a third of those facilities were severely damaged, and estimated it could take up to 2 years to restore output to pre-war levels. On March 11th, the 32 member countries of the IEA agreed to release 400 million barrels from their strategic reserves, the largest coordinated stock draw in the agency's history, larger than the 182 million barrel release after Russia invaded Ukraine. And even that historic release was described by the IEA's director as merely reducing the pain, not solving the problem. When the ceasefire was announced on April 8, oil prices dropped from approximately $110 to $95 per barrel. That drop was presented on American television as a resolution, but $95 per barrel is still 35% higher than the pre-war price of $70. And the strait is still not open, and 230 tankers are still waiting. And mines that Iran planted in the waterway have, according to at least one report, been lost by Iran itself, meaning Iran may be physically unable to fully reopen the strait even if it wanted to. The IEA did not call this the greatest energy security challenge in history because of what happened during the 6 weeks of fighting. They called it that because of what the fighting revealed about the structural fragility of the global energy system. 20% of the world's oil flowing through a waterway that one country can close with mines and naval vessels in a matter of hours. That vulnerability existed before February 28th. It was invisible. Now it is visible, and the markets will never forget what they saw. The IEA also documented the scale of physical infrastructure destruction. Saudi Arabia's largest refinery was targeted by drone attacks. Qatar's LNG export facilities, which supply a significant portion of global liquefied natural gas, were hit. Pipelines connecting production fields to export terminals across Iraq and Kuwait were damaged or destroyed. The IEA warned that some fields may require specialized oil field services, including workovers, coiled tubbing units, chemical treatments, and perforation to restart. Fields relying on secondary or enhanced oil recovery could face the longest restart times because they depend on uninterrupted supplies of gas, power, steam, and chemicals that were themselves disrupted. And the remaining 20% of damaged fields that have not been addressed may prove harder to restart due to pressure depletion or flow impairment. In plain English, some of the oil production capacity that was destroyed during the fighting may never come back. The wells are damaged at the geological level. The reservoirs have depressurized. The chemicals needed to restart them are unavailable because the supply chains that deliver those chemicals run through the same waterway that is blocked. And the insurance costs for any tanker attempting to transit the Strait of Hormuz have skyrocketed, with maritime insurance premiums rising by multiples that make certain trade routes economically unviable even if the strait were fully reopened tomorrow. The physical damage, the geological damage, the insurance market damage, and the confidence damage are all operating simultaneously. And none of them are resolved by a press conference announcing a ceasefire that collapsed within 24 hours. The inflation that already hit your grocery bill in March will keep climbing for months, even if peace holds. The Bureau of Labor Statistics released the March 2026 Consumer Price Index on April 10th. The headline number was a 0.9% monthly increase, the largest single-month jump since May 2022, at the peak of the post-pandemic inflation crisis. The annual inflation rate climbed to 3.3%, up from 2.4% in January. And the driver was energy. The March CPI showed energy prices increasing 10.9% in a single month, the largest monthly increase in the energy index since September 2005, the month after Hurricane Katrina devastated Gulf Coast refining infrastructure. Gasoline prices rose 21.2% in March. Fuel oil increased by more than 30%. And Al Jazeera reported that even after the ceasefire announcement, Americans were still paying $4.15 per gallon at the pump, according to the American Automobile Association. That is up from less than $3 before the fighting began. And the fuel price increase is only the first wave of inflation that the war will generate. Energy costs are embedded in the production cost of virtually everything in the American economy. The food you eat was grown with fertilizer made from natural gas, harvested with diesel-powered equipment, processed in facilities powered by electricity generated partially from natural gas, refrigerated and transported by diesel trucks, and displayed in grocery stores lit and cooled by electric power. When energy costs rise 10% in a month, food prices do not rise 10% in the same month. They rise 3 to 5% over the following 60 to 120 days as the energy increase works through every step of the supply chain. The March CPI captured the initial energy shock. The April, May, and June CPI reports will capture the secondary and tertiary effects as that shock propagates through food, services, transportation, and manufacturing. CNBC's analysis published yesterday confirmed that the inflation surge during the war has not yet fully materialized in consumer prices. The monthly headline CPI was 0.9%, but core CPI, which excludes food and energy, was only 0.2%. That divergence tells you that the energy shock has arrived but has not yet cascaded into everything else. It will. And when it does, the Americans who believed the ceasefire meant the inflation was over will discover that inflation operates on a lag. The war lasted 6 weeks. The inflation it created will last 6 to 12 months minimum, regardless of what happens in the Strait of Hormuz tomorrow. And the European Central Bank has already warned that a prolonged conflict will likely trigger stagflation and push major energy-dependent economies, including Germany and Italy, into technical recession by end of 2026. Oxford University's economics department modeled that the UK and the Eurozone as a whole were at risk of contraction. Shell issued a warning that Europe could face a fuel shortage as early as April. Chemical and steel manufacturers across the EU and UK have imposed surcharges of up to 30% to offset surging electricity and feedstock costs. Those surcharges will be passed to American importers of European goods, adding another layer of price increases on top of the direct energy shock. The global economy is interconnected. When European manufacturing becomes 30% more expensive because of energy costs driven by a war in the Middle East, American consumers who buy European cars, European pharmaceuticals, European machinery, and European consumer goods pay more. The inflation is not confined to gasoline. It is cascading through every supply chain that touches energy at any point in the production process. And in the modern global economy, every supply chain touches energy at every point. Consumer sentiment just hit the lowest level ever recorded, and almost all of it happened before the ceasefire. The University of Michigan Consumer Sentiment Index, which has been tracking American economic confidence since the 1950s, fell to 47.6 in early April 2026. That is the lowest reading in the entire history of the survey. Lower than during the 2008 financial crisis, when the American banking system collapsed and 8.7 million people lost their jobs. Lower than during the pandemic lockdowns of 2020, when GDP contracted 31% annualized in a single quarter. Lower than during the 1970s stagflation, when inflation hit 14% and gasoline lines stretched for miles. Lower than September 2001. Lower than every recession, every crisis, every war in the past 75 years. And the survey's director, Joanne Husu, noted that almost all of the responses came before the ceasefire announcement. Which means the ceasefire may provide some temporary improvement in the next reading, but the damage to consumer psychology has been done at a structural level. When confidence drops to a record low, it does not bounce back because a news headline says the fighting stopped. Confidence rebuilds when prices stop rising, when jobs feel secure, when the future feels predictable. And none of those conditions exist in America right now. The University of Michigan survey also showed that consumers anticipated a surge in inflation over the next 12 months, which matters because inflation expectations can become self-fulfilling. When consumers expect prices to rise, they buy sooner to avoid the increase, which increases demand, which pushes prices higher, which confirms the expectation. This feedback loop was one of the key mechanisms that made 1970s inflation so difficult to break. And the March 2026 inflation data, combined with the war and the failed ceasefire, has created the exact conditions for that loop to reactivate. Al Jazeera reported that the deterioration in sentiment was across age, income, and political party affiliation. The open-ended comments in the survey showed that many consumers specifically blamed the Iran conflict for unfavorable changes to the economy. And J.P. Morgan's chief global strategist David Kelly cautioned that while low sentiment has not historically been a reliable predictor of consumer behavior, the current environment is different because the sentiment decline is being driven by actual price increases that consumers experience at the pump and in the grocery store, not by abstract fears about policy or politics. The anxiety is material. It shows up in the receipt, and receipts do not lie. A Financial Times investigation found that $580 million in bets were placed 15 minutes before Trump's ceasefire statement. On March 23, 2026, 15 minutes before President Trump published a statement announcing that he was postponing attacks on Iran for talks, $580 million in bets on falling oil prices were placed with the stock market by selling oil futures. The Financial Times reported the trades and the timing, and the result was immediate. Oil prices dropped when the statement was published. The people who placed those trades made enormous profits within minutes. The Financial Times investigation triggered speculation about insider trading and calls for further investigation. Whether or not those trades were based on advance knowledge of the statement is a question for regulators and law enforcement. What is not a question is what those trades represent about the relationship between American foreign policy and financial markets in 2026, the war that is determining the price of oil, the cost of gasoline, the inflation rate, the interest rate trajectory, and the financial future of every American household is also generating trading opportunities for people with access to information about what the president will say before he says it. The $580 million in trades were placed by entities that knew, or correctly guessed, that Trump was about to announce a pause. And the announcement moved oil prices enough to generate massive returns for whoever was on the right side of the trade. And the American consumer who is paying $4.15 at the pump is on the wrong side of the trade. Every time. Because ordinary Americans do not have access to the timing of presidential statements, they do not have the ability to place $580 million in oil futures. They do not profit from the volatility that the war creates. They pay for it. Every time the war escalates, they pay more at the pump and more at the grocery store. Every time a ceasefire is announced, the price drops slightly, but never back to pre-war levels. And the people with advance access to the timing of those announcements capture the spread. The war is a cost to ordinary Americans and a profit center for people with information advantages. And the ceasefire that was supposed to end the crisis is itself generating trading events that benefit the connected and penalize the public. That is not a conspiracy theory. That is a Financial Times investigation into $580 million in documented trades placed 15 minutes before a presidential statement. And the broader stock market impact on ordinary Americans has been severe. Global stock markets experienced declines throughout March, bond markets sold off. The 10-year Treasury yield spiked, pushing up mortgage rates and corporate borrowing costs. The Americans who have 401k retirement accounts, who have IRAs, who have college savings plans, who have pension funds invested in balanced portfolios of stocks and bonds, watched their account values decline during March and early April. Not because they made bad investment decisions, but because a war they never voted for destabilized the markets their retirement depends on. The S&P 500 has declined from its pre-war level. Bond prices have dropped as yields have risen. And the diversified portfolio that financial advisors recommend for retirement, typically 60% stocks and 40% bonds, was hit on both sides simultaneously. Stocks fell on economic uncertainty, bonds fell on inflation fears. There was no safe haven inside the traditional portfolio. The only assets that rose were oil itself, gold, and defense stocks, which means the crisis benefited the energy companies, the gold holders, and the weapons manufacturers while penalizing everyone else. The people who were already wealthy enough to hold commodities and defense equities got wealthier. The people who hold a standard retirement portfolio and a target date fund at Fidelity or Vanguard got poorer. The war distributed wealth upward. The ceasefire did not redistribute it back. The Fed cannot cut rates now, and that means your mortgage and your credit cards stay expensive indefinitely. Before the Iran war began, the expectation among economists and market participants was that the Federal Reserve would continue lowering interest rates in 2026 to support a slowing labor market. Rate cuts would have reduced mortgage rates, auto loan rates, credit card rates, and the cost of borrowing for businesses and consumers. Those rate cuts are now effectively off the table for as long as the energy-driven inflation persists. CNBC reported that the most obvious obstacle standing in the Fed's way is inflation. Prior to 2026, the central bank was on a path toward neutral. Now, with the CPI at 3.3% and rising, with energy prices having spiked 10.9% in a single month, and with inflation expectations among consumers surging to levels that risk becoming self-fulfilling, the Fed cannot cut without risking a repeat of the 1970s mistake where the central bank eased prematurely and allowed inflation to become entrenched. Joseph Bruce, chief economist at RSM, drew a line at $125 per barrel for West Texas Intermediate crude as the point where the oil shock becomes a serious macroeconomic problem that could tip the economy into recession. WTI is currently around $95. The gap between the current price and the recession trigger is $30 per barrel. If the Islamabad talks remain failed, if the naval blockade escalates, if Iran retaliates against U.S. destroyers clearing mines in the Strait, oil could cross $125 in days, not weeks. And the Fed would be forced to choose between cutting rates to support a collapsing economy and holding rates to fight inflation that is being driven by an energy shock they cannot control. That is the definition of stagflation. Low growth, high inflation, and a central bank with no good options. The last time America experienced stagflation was the late 1970s and early 1980s, and it took Paul Volcker raising rates to 20% and deliberately triggering a deep recession to break the cycle. Nobody is currently prepared for that policy response, and the ceasefire that was supposed to prevent this scenario from developing has already collapsed. The 30-year mortgage rate climbed to 6.38% on March 26th, its highest level since July 2025. The 10-year Treasury yield jumped to 4.46% on March 27th. Those increases happened during the fighting. They did not reverse when the ceasefire was announced, because the bond market, unlike the evening news, does not believe the ceasefire will hold. The bond market is pricing in sustained energy disruption, sustained inflation, and a Fed that cannot ease, and the bond market is where your mortgage rate comes from. The cost to the American taxpayer for a war that was never authorized by Congress is climbing into the hundreds of billions. Operation Epic Fury, the codename for the U.S. military campaign against Iran, involved precision-guided munitions, stealth aircraft, naval deployments, mine clearance operations, and the ongoing enforcement of a naval blockade of the Strait of Hormuz. Each Tomahawk cruise missile costs approximately $2 million. Each JDAM precision-guided bomb costs approximately $25,000. Each B-2 stealth bomber sortie costs approximately $170,000 per flight hour. Each aircraft carrier battle group costs approximately $6.5 million per day to operate. The naval blockade declared on April 13 requires continuous deployment of destroyers, cruisers, minesweepers, and logistical support vessels in one of the most contested waterways on Earth. And the Strategic Petroleum Reserve releases that have been coordinated through the IEA, including the 400 million barrel draw announced on March 11, represent the depletion of emergency reserves that will cost tens of billions of dollars to replenish at current oil prices. The American SPR was already at its lowest level since 1984 before the war began, standing at approximately 403 million barrels. Every barrel released to manage the Hormuz crisis is a barrel that is not available for the next crisis. And refilling the SPR at $95 per barrel cost dramatically more than the $70 per barrel price at which the strategic reserves were accumulated. The direct military cost of the operation has not been publicly disclosed. The indirect cost to the American economy through higher energy prices, higher inflation, higher interest rates, delayed rate cuts, reduced consumer spending, declining business investment, and the drag on GDP growth is being measured in the tens of billions per quarter. Mike Scordellis, head of U.S. economics at Truist Advisory Services, told CNBC that the war will gouge out some of the growth. J.P. Morgan Asset Management's David Kelly projected real consumer spending growth at only 0.8% this year, barely above stagnation, before recovering to 1.7% in 2027. And the war was launched without congressional authorization. Democratic lawmakers have been rebuking the president for launching the war without the approval that the Constitution requires. The War Powers Act gives the president 60 days to conduct military operations without congressional authorization. The 60-day clock started on February 28. It expired in late April, and neither the House nor the Senate voted to authorize the continuation of military operations. The American taxpayer is funding a war that was never voted on, paying for it through higher prices at the pump and the grocery store, absorbing the inflationary shock through reduced purchasing power, and watching their retirement accounts fluctuate with every headline from a conflict zone that most Americans could not locate on a map 6 months ago. And the long-term cost to the American economy extends beyond the direct military spending and the energy price shock. The Anadolu Agency reported that Iran's retaliatory attacks on U.S. bases in Qatar, the UAE, and Bahrain injected uncertainty into global markets and raised alarm bells for economic policymakers in Washington. BCA Research's analysts warned that energy and commodity markets are likely to remain on a structurally higher floor regardless of the ceasefire outcome, because governments around the world are now hoarding and restocking energy reserves in anticipation of renewed conflict. That hoarding behavior keeps prices elevated well above pre-war levels, even in a best-case scenario where shipping fully resumes. The war has permanently repriced the risk premium that the global energy market assigns to Middle Eastern supply. Before February 28, the market treated Strait of Hormuz disruption as a tail risk, a low-probability event that was theoretically possible but practically unlikely. After February 28, it is a demonstrated reality. The market has seen it happen. It has seen 230 tankers trapped, 10 million barrels per day removed from supply, and $120 oil. That memory does not fade. It is now embedded in every futures contract, every insurance policy, every shipping rate, and every investment decision that involves energy for the foreseeable future. Thornburg Investments portfolio manager Josh Rubin cautioned against reading the early market reaction to the ceasefire as a definitive verdict, warning that tail risks remain if the strait stays closed for another 2 to 4 months. And Aberdeen Investments economist Michael Langham said the ceasefire will likely hold in the near term given the economic costs, but the fundamental trust deficit between Washington and Tehran makes a lasting peace extremely difficult. The ceasefire is a pause, not a resolution. And pauses in geopolitics are the moments where both sides rearm, reposition, and prepare for the next escalation. The American consumer is paying the cost of the current pause and will pay the cost of the next escalation when it comes. The lie that America believed was not a single statement. It was a series of reassurances delivered over 6 weeks that the situation was under control, that the strikes would be surgical, that the strait would stay open, that Iran would not retaliate seriously, that the ceasefire would hold, that prices would come back down, that the inflation would be temporary, that the war would be over quickly. Every one of those reassurances was wrong. The strikes triggered massive retaliation, including missile and drone attacks on U.S. bases in Qatar, the UAE, and Bahrain. The strait did not stay open. Iran closed it within hours, and it remains effectively closed today despite the ceasefire. The ceasefire did not hold. By April 9th, ships were being blocked again. By April 12th, talks had failed. By April 13th, the president declared a naval blockade, and the IRGC threatened a severe response. Prices have not come back down. Oil is still 35% above pre-war levels. Gasoline is still above $4. The March inflation report was the worst monthly spike in nearly 4 years, and consumer sentiment is at the lowest point ever measured in 75 years of survey data. The lie was that the crisis would be contained. The truth is that the crisis has been distributed across every gas station pump in America, every grocery store receipt, every utility bill, every insurance premium, every auto loan payment, every mortgage rate adjustment, every retirement account that lost value during the March sell-off, every household budget that was already stretched to breaking before February 28th and is now absorbing a cost of living increase that was entirely avoidable and was created by a war that the American people never voted for and were never asked to approve. The price of the lie is not measured in barrels of oil. It is measured in meals skipped, prescriptions unfilled, savings depleted, credit cards maxed, car payments missed, and retirements postponed by people who were told the ceasefire meant it was over. It is not over, and every American will pay for it. Every American is already paying for it. The only question is how long, how much, and whether anyone in a position of authority will tell the truth about the cost before the midterm election in November, when the voters who are paying the price will have their first opportunity to respond. Share this video with every American you know who drives a car, buys groceries, pays an electric bill, or has a retirement account. Because the connection between the war they are being told is resolved and the prices they are paying right now is a connection that has not been made on any mainstream news broadcast in the clear, specific, data-driven language that ordinary Americans need to understand what is happening to their money and why. Subscribe and turn on notifications because this situation is changing daily and I will track every price movement, every diplomatic development, every inflation report, and every market reaction in real time. No spin, no party line, just the cost of the lie and the truth about who is paying it. Take care of yourselves out there. Clarity has never been more expensive or more necessary.